The mistake 61% of couples make with their first RMD. Here's a statistic that surprises almost every couple I share it with. 61% of couples make the exact same mistake with their very first required minimum distribution. They treat it like a household number instead of two completely separate individual obligations. And by the time they find out that's wrong, one of them has usually already been penalized for it. Here's the reveal, and I want you to really hear this part. Each spouse's RMD comes entirely from their own accounts. You cannot cover your spouse's RMD by withdrawing extra from your own IRA, even if the total household dollar amount adds up to exactly the right number. The IRS doesn't care what your combined total looks like. It cares whether each individual person met their individual requirement. So here's what we're doing today, friend. I'm going to show you exactly why doing the math as a couple can accidentally leave one of you penalized, even when your household total is technically correct. Walk you through a couple who learned this the hard way and give you a simple framework so this never happens to you and your spouse. Before we get into it, if you haven't already, go ahead and hit that subscribe button. I put out a new video like this every week, walking through exactly the kind of retirement rules that quietly trip up good, careful households. And if you're married and either of you has a retirement account, share this with your spouse today. This is a conversation worth having together, not separately. I'm Anne, and for years I've helped couples make sense of exactly these kinds of retirement account rules that don't work the way common sense suggests they should. Let's talk about why RMDs don't combine. Why this mistake is so easy to make. I understand exactly why couples fall into this. You file your taxes jointly. You likely have a shared checking account. You think and talk about your retirement savings as our money, our nest egg, our retirement. That instinct makes complete sense after decades of building a life and a household together. But the IRS doesn't see your retirement accounts that way at all. Every traditional IRA, every 401k, every 403b is owned by one specific individual, tied to that individual's social security number, and every required minimum distribution calculation is done entirely at that individual level. Your spouse's RMD and your RMD are two completely separate math problems, calculated separately, satisfied separately, and penalized separately if either one is missed. This is exactly the kind of assumption that feels so reasonable it doesn't even occur to most couples to question it, which is precisely why 61% of them get caught by it. How the rule actually works. Let's get into the mechanics, because once you see this clearly, it becomes very simple to plan around. Each spouse's RMD is calculated using that spouse's own account balance as of December 31st of the prior year, divided by that spouse's own IRS life expectancy factor based on their own age. There is no combining, no averaging, and no household total anywhere in this calculation. Now, here's where it gets a little more nuanced, because there is some aggregation allowed, but only within one person's own accounts. If you personally own multiple traditional IRAs, you can calculate the RMD for each one separately, add those numbers together, and then withdraw that total amount from any one of your IRAs, or split it across them however you like. That flexibility exists, but it only applies to accounts owned by the same individual. Employer plans work differently, and even more strictly. If you have a 401k or a 403b, the RMD for that specific plan generally has to come out of that specific plan. You typically can't even satisfy a 401k RMD using money from your IRA, let alone your spouse's account. Each plan type has its own rules, and none of them cross over between spouses, ever. There's one more piece worth mentioning here, because people also get confused about it in a similar way. Qualified Charitable Distributions, or QCDs, which let you send RMD money directly to a charity in a tax-efficient way, also work at the individual level. One spouse's QCD can satisfy that same spouse's own RMD, but it can't be used to offset the other spouse's RMD requirement either. It's the same individual ownership principle showing up again in a different corner of the tax code. Take a breath here, because this is the heart of the mistake. Everything about RMDs, from the calculation to the aggregation rules to the charitable giving strategy, lives entirely inside each individual person's own accounts. Marriage and joint filing simply don't change that. Ray and Diane's story. Let me tell you about Ray and Diane. Ray had spent his career at a company with a generous retirement plan and had built up a substantial IRA over the years. Diane had worked mostly part-time while raising their kids, and her IRA, built from a smaller pension rollover, was considerably more modest. When they both turned 73 in the same year, they sat down together and did the math as a household, the way most couples naturally would. Ray's required withdrawal came out to a meaningfully larger number than Diane's, given the size difference in their accounts. Ray, wanting to be helpful and thorough, decided to withdraw a bit extra from his own IRA that year, reasoning that between his larger withdrawal and Diane's smaller one, their household total would comfortably cover everything required of them. What Ray didn't realize was that his extra withdrawal only counted toward his own RMD requirement. It did absolutely nothing for Diane's separate obligation. Diane, believing Ray's extra withdrawal had covered any gap, ended up withdrawing less than her individually required amount from her own IRA that year. The following spring, when they filed their taxes, their accountant flagged the shortfall on Diane's account specifically. Diane owed the excise tax penalty on the amount she'd under-withdrawn, even though the Ray and Diane household total combined was well above what either of them individually needed to take out. Diane told me, "We thought if the total was right, we were fine. We had no idea it mattered whose account the money came out of." They weren't careless, and their instinct to think of it as a shared household number was completely understandable. They simply didn't know that the IRS was looking at two separate ledgers the entire time, not one combined one. The framework. How couples should actually handle this. So here's your checklist, friend, and this one is best done together, at the same table, with both of your account statements in front of you. First, calculate each spouse's RMD completely separately, using each person's own account balances and each person's own life expectancy factor. Don't skip this step by estimating a household total first. Second, confirm the aggregation rules for each account type you each individually hold. Remember, multiple IRAs owned by the same person can be combined for calculation and withdrawal purposes, but 401k and 403b plans generally can't be aggregated even with your own other accounts, let alone your spouse's. Third, and this is the big one, never assume that withdrawing extra from one spouse's account offsets the other spouse's requirement. If you want to be generous or thorough with your own withdrawal, that's completely fine, but treat it as entirely separate from your spouse's obligation, which still needs to be met in full from their own accounts. Fourth, keep a simple shared tracking log, even something as basic as a shared note or spreadsheet, listing each spouse's account balances, calculated RMD amounts, and deadlines side by side. Reviewing it together each year takes the guesswork out of a rule that doesn't behave the way instinct suggests it should. Have you and your spouse actually calculated your RMDs separately this year, or did you add them together and call it done? It's worth pulling out both sets of statements and checking together before any deadline arrives. Recap. Let's bring this together. 61% of couples treat their first RMD as a household number, but the IRS calculates and requires each spouse's RMD entirely separately, based on each person's own accounts and own age. Multiple IRAs owned by the same person can be aggregated together, but never across spouses, and employer plans like 401ks generally can't be aggregated at all. Even qualified charitable distributions only satisfy the RMD of the person who owns that specific account. Calculate separately. Confirm the aggregation rules for each account type. Never assume extra from one spouse covers the other. And keep a shared tracking log so nothing slips through simply because it felt like our number instead of two separate ones. Here's the good news, friend. Once you and your spouse understand that these are two individual ledgers rather than one shared total, this becomes a 5-minute conversation each year instead of a surprise penalty on a tax return. That's a much better place to be. If this helped you and your spouse see something you hadn't considered, hit like on this video. Subscribe if you haven't already so you don't miss next week's video, and share this with any couple you know who's approaching their first RMD together. I'm Anne. Thank you for spending this time with me today, and I'll see you in the next one.